We're going to take a look back at technology investing over the past little while. And for the past decades, software stocks were the key driver in the big rally in tech space. But of course, with the rise of semis, AI, semis are now really in the spotlight. Are we seeing the latest shift in tech, and what else should we be thinking about? My next guest says a lot has changed over the last 10 years, and he's here to break it all down for us. Maybe to better help us understand the future, Vitali Mossounov is Managing Director, Head of Research, Fundamental Equities at TD Asset Management, and he joins us from Regina. Vitali, nice to have you with us.
Yeah, it's a pleasure to be on the show again, this time virtual, but I think the conversation will be as good as always.
I think it will be. So let's start when you frame up and look backwards over the last decade, and you think about technology performance versus, say, the overall market performance. Tell me what we're looking at here. You got a chart to show that, but why you think it's important to look at?
Well, it's because we've known each other for 10 years. You know, we have very animated, spirited discussions about in any given period or quarter, how's Amazon doing? How's Meta doing? What's the controversy? Is it out of favor, in favor? But we sometimes want to bring our audiences back to the bigger picture, and it's what we'll call the golden age of technology investing. Looking back 10 years, and we're using the NASDAQ here as a proxy for technology returns, just seeing that growth in users, that growth in pricing, that growth in earnings of those businesses, driving those returns to be 2, even 3 times higher than that of the S&P, or the S&P stripping out tech. Really, that's the bottom line there, 200-something% return compared to over 500% for the NASDAQ. So again, it's really just an awareness that we're always having these animated, spirited discussions, as we would with good friends at a dinner party, again and again and again over the years. And we'll have debates. We don't want to lose sight of the bigger picture, where these are good friends, and in a market context, these are good friends that are also enriching our lives if we invest in them properly.
Some friends are more interesting than others, Vitali, and I think that's what we're going to talk about a little bit in terms of who we invite. But right. you talk about, you know, even though we saw that chart up and to the right, what was driving that chart up and to the right has been changing over time. And so I know you've got to look here at basically where the returns have been coming from when you start to dive into tech.
Yes, indeed. Some guests sort of just show up, and and it is what it is. We all have those in our life. What we're doing here is breaking down that golden age into 3 epochs, if you will. The first bar is your pre-COVID era. Think of that as 2015 up until the pandemic. The middle bar is the pandemic. And then we have the GPT era, I call it, after November 30th, 2022. Each bar corresponds, its height corresponds to the returns of that era. 140-something% in Epoch 1, lower returns during COVID, of course, with the drop and subsequent rise, and then again another 100-something% in the GPT era. And as you look around, the size of those individual slices correspond to the contribution to that return from the biggest positive contributors. And what's interesting, there's a saying from a 19th century French satirist, which is, the more things change, the more they stay the same, right? And if you look at tech the last 10 years, well, isn't that the epitome of change, right? And yet at the same time, as you look across the board, there are these big companies, Meta, Microsoft, Google. Well, look, from the left to the right, they are always some of the biggest contributors to your returns. You cannot not have these guests. You do not want to skip that one. They've got good jokes, right? In the middle, we see Tesla arriving on the scene during COVID. We see NVIDIA arriving at the dinner table. And when you look over to the right, you see that Broadcom joins the fold. So the composition changes, but look at the consistency with which your most interesting guests, your best friends, are contributing to your success here.
Amazon looks less interesting. I'll just say that as we kind of go over to the right, I think. So it's, I was just looking at the color coding. It's a fascinating chart. Can I ask you, what is it that you think we should be taking away when we look at that? What is the core thing we should be doing or not doing?
Well, the core thing here is to invest in these champions of change. And I think what we keep reminding our audiences is, look, there's a lot of debate and conversation, again, animated, spirited debate every single day, and it could lead somebody to take action to sell something or buy something on any given day, But you look back a decade and the value creation for investors from the world's biggest and best companies through their data, through their people, through their technology is actually very, very consistent. So what you want to do is find a way to invest in technology that is repeatable, that is consistent, that is really something that you're not going through guessing at, what should I put in the portfolio today and take out tomorrow.
And what would be a way of doing that?
Well, Kim, you know what I'm going to say. We have the Global Technology Leaders Index ETF, and I've mentioned it so many times that I suppose I should say it again, given your cue. But it is that very product. It's got a 6-year track record now, and that's all it does. It looks and understands what is the technology landscape out there, who are the winners. And really, if you simplified, it's investing in the winners and rebalancing towards the winners. And that is what you have. A winner takes most paradigm within technology, where the big keep getting bigger, $1, $2, $3, $4 trillion in market cap, 50, 100, 150, $200 billion in revenue. So that is certainly our preferred way to do it.
Vitali, you want to talk a bit about the idea of value creation versus value extraction. So why? Why are we talking about this?
Well, we're talking about it because while tech has been an incredible investment relative to the market in the last decade of this golden era of technology investing, we saw, as you mentioned, that the constitution of those returns changes. And something we're watching very closely as an analyst team is what role is every company playing, and what point in the life cycle is it at of adding value versus reaching a stage where they begin to extract value. As an example, you're creating value when you're offering a product or service that is growing the entire economic pie. Perhaps it's creating a step function change in productivity. We're doing something else that's clearly of benefit to society, to an organization, to an individual. At a certain point, though, you fail to keep adding value, but you may still have a grip on the marketplace, and you turn into a value extraction company. When you look and you say, I can't add a new feature to my product. I can't find that incremental user that needs my service, but I can raise price, and I will raise price. And I think that concept of value creation to value extraction, while it can seem a bit, conceptual, is very relevant for understanding when companies and which companies will outperform the market and underperform the market, as we investors are very good at recognizing what stage a company is at and distributing our funds, investments accordingly.
Can I say this back to you just to see if I understand? So value creation would be somebody who's creating a new category, maybe, or inventing something that wasn't there before.
Frankly, right? Yeah.
And then value extraction would be the category exists. I'm just another player in that space, or there's not enough innovation that it's just like you said, it's maybe a new brand within or just different pricing.
That's exactly it. Yeah.
Okay. So when we look now, and tell me again, so just I'm going to keep pulling the string here. Why is that important to think about, and how do you think about that when you look ahead?
Well, it's important to think about, maybe cue a chart here where we're showing something that may seem unrelated at first, but it's the relative returns of semiconductors relative to software. And why I'm using this as an example is, these are two of the biggest technology sector constituents, right? This is what you're investing in large part when you are buying a technology ETF like ours. Well, software, first to understand the chart, just remember, if it's going up, if that slope is positive, then semis are outperforming software. And when it's going down, then it's the opposite. When it's going down, semis are underperforming software. So look at that period from 2015 to roughly 2020. In that period, you have semis failing to outperform software often doing better. And as I think about that, I reflect on those companies during that time period. That's when software companies were coming out with very innovative features that would enhance our productivity at work, say a Zoom, right, or another business that was generating really apps or tools that had not yet seen before in the workplace. The same thing with consumer internet and some of these tools like Instagram or YouTube enhancements. And then you get into the second period of that chart where you have really semis taking off, right? Even before ChatGPT, semis really outperforming software. And to us, the way we think about that in the framework I described is, well, you reach a point which many software companies have reached when you have already reached every user within a company, within a society. You have already added all the value that you can, and the only thing that you can do now to generate value for shareholders is raising the price on your users, right? And we see that actually happening without naming any names, but we've all been subject to it in some of our personal lives, and of course, companies and industries. And on the semiconductor side, what the market's telling you there is, wow, there's a whole bunch of companies that are still in value creation mode, right? The chips that NVIDIA is designing, those same chips that TSMC is fabricating, so many examples we can go on and on. That's still a very clear value creation mode. As I said earlier, expands that economic pie, right? So this is, Kim, the way we think about it, because I want to emphasize the consistency of technology investing, but within it, you need to have frameworks and you need to know what it is to own and what to perhaps to avoid.
Vitali, how do you think about Intel? Because Intel was one of the originals when it came to semis, and it's had a huge turnaround. So where does that fit in your model?
Yeah, Intel's an interesting one, and Intel is a company that was in the lead. So if you think about semiconductor companies, Intel, you can call it an IDE. It's effectively completely vertically integrated. They design their chips and they manufacture them. And until about 2018, they were unrivaled in their leadership, right? And we all grew up, frankly, going as far back as seeing that Intel Inside sticker that meant so much in terms of quality and performance. Around that time, they made a poor architectural decision, a little too much conservatism, you could say, and they were overtaken by the Taiwanese foundry, some call it, TSMC. And today that is who's in pole position with respect to manufacturing. So, fast forward, Intel has really gone from a highly profitable company to one that had to cut its dividend, that started posting, frankly, losses, and has had to make very serious decisions now. Recently, another management change. Frankly, a turnaround story, and a very difficult one because it's a technology turnaround story. And once you fall behind in something that changes as fast as semis, very difficult to catch up. So Intel, why it's in the news is you're seeing the U.S. government come out. Last year, they basically gave them a large grant for something like $8 billion. This year was all consolidated to say, look, we're just going to take an equity stake. A lot of countries do this, but the U.S. has not historically acted this way. They said, we're just going to own effectively 10% of the company of Intel. There are certain restrictions now on the business. But effectively, I think what the U.S. government doing is saying, hey, we've been asking TSMC to bring their manufacturing into the United States. We're all observing this big geopolitical shift in strategy. But we're also saying Intel is a homegrown talent that's really struggling. What can we do to shore up their potential? But Intel's a tricky one, and I go into the essence of your question. It's got a lot of wood to chop to get back anywhere close to the winner's circle.
Well, the being up 90% certainly is quite a bit of chopped wood, to put it your way. But I know what you're talking about fundamentally. I've only got about 30 seconds here. I just wanted to ask you about OpenAI, if I could, because that's something, of course, that's been driving a lot of some of the semiconductor action.
Well, we have a revolutionary technology, ChatGPT, we'll just call it that is owned by OpenAI. And whenever you bring forward a revolutionary technology, first, that only happens every few decades. And when it happens, it's a really big deal. I think it's very early in the adoption of that technology by all of us as the technology exists today. And the technology is still evolving very quickly. So OpenAI is a very exciting company. And there are a lot of conversations about what it's worth, what it should be worth. But I think we should just stay tuned because there's a lot more exciting developments to come from the whole Gen AI space, period.